When it comes to Forex, position sizing refers to the appropriate number of units to buy or sell a currency pair. Traders use position sizing to determine how many units of instruments they should purchase, which helps them to minimize risk and maximize return. It is one of the most important skills for a Forex trader. The position size is determined by type, size, and number of lots that a trader buys or sells. A micro lot is 0.01, which equals to 1000 units of a base currency. A mini lot is 0.10, which equals to 10,000 units of a base currency. A standard lot is 1.00, which is equals to 100,000 units of a base currency. In order to determine the Forex position size, traders must set a percentage limit on each trade. For example, if a trader has 10,000 in his trading account and decided to risk only 1% per trade, then the trader should not lose more than $100 per trade. For every trade a trader makes, this limit becomes a guideline. In this case, to set the ideal position size, let's assume a trader would like to open a new order on Euro-USD currency pair. The simple formula to calculate the ideal position size will be the $100, which is the risk amount, divided by 100 pips stop loss times $10, which is the value per pip. So the position size will be 0.1, which is equal to 10,000 units. Usually, a professional trader will not risk more than 2% of his capital on each trade. It is important to know that for the pairs in which the USD is not listed as a quoted currency, the pip per value will depend on the exchange rate, which a trader needs to know in order to use this formula.